Hey there. Subscribe to my channel. And also press this bell icon.
The 20 MA is the single most important tool I have ever discovered in trading. Some basic information first, MAs, moving averages, don't forget, are directional guides and speed up technical analysis of trends. So the basic information is that the color of the moving averages should be consistent across multiple timeframes. If you, let's say, use more than one moving average, then you want to make sure that the same moving average, each moving average, has the same color across multiple timeframes. So you're not confused. The type of moving average really does not matter. A lot of people ask me, do you use exponential moving averages, weighted moving averages, or simple? I use simple because that's what most people use. And I want to, and my job is to read other traders' psychology, right? The traders that are on the other side of the trade. And so I want to see what they're seeing. And that's why I use simple, but regardless of which type you use, it should be consistent on all time frames. Okay? Moving averages are superior tools in uptrends and downtrends when the stock is uptrending in a stage 2 or downtrending in a stage 4. In sideways trends, their importance is greatly minimized. We see Facebook here on the data chart. You can see while it's uptrending, it stopped at the moving average, at the dipped a little bit below it, but went back up when it's in a downtrend. Beautiful. Same thing, short at the 20, at the 20, at or near the 20. When it's sideways, how does this moving average tell me where the stock is going to go next? How would it doesn't, right? It's going through price. So again, when the stock is going sideways, when the moving average is sideways, it's not very useful. When stocks are about to transition up or down, the moving average will start to hug price and curl. That's your indication that the stock is about to transition into a stage 2 uptrend or a stage 4 downtrend. Here's what I mean. You have a stock that was in a stage 1, sideways stage, moving average was going through price, no good. But this is why I keep the moving average on the chart, regardless of the stage the stock is in. Because right when it's about to break out, notice how the moving average halts, HALTS, halts the stock, and it starts to point up a little bit, curl, and then bam, the explosion. So, and it's not, I didn't just pick this. You can look at any chart you want, and you just follow the trend and see how the moving average gives you kind of the heads up right when the stock is about to break out. Notice again the curling, and then as soon as it's while it's going through price, you know the stock is not ready. Again, while the moving average is going through price, then you know the stock is not ready. But when it goes below it, then you know it's probably ready. Does that make sense? Notice here. And so while it's going through the moving average, it's not useful. But this is why, again, I want to keep the moving average on the chart, is because it gives me the heads up that it's about ready to go when it halts price and starts to turn up a little bit and then pops, right? Same here, going through price, not very useful, but check it out here. The stock couldn't drop below it now, unlike before. Couldn't drop below it, now I'm going to play a breakout. As soon as it breaks, I'm going to be in. Does that make sense? So, and that is known as transition A. Another example that goes to show you how important it is, that's why I'm giving you all these examples. Notice here, stock halt, or the moving average halted the stock from dropping below it, then you know it's about ready to go. And more examples, right? The same happens when the stock is turning bearish. You get the uptrend, right? And let's pretend this is the moving average. And then the stock breaks the moving average, starts to go sideways, and then as soon as the moving average starts to curl and point down, then I know the stock is ready to go, ready to break down. And that is called transition C, breakdown. Instead of transition A, breakout, this would be called transition C. All right. The direction of the 20, a rising 20 MA, represents positive market action or strength. A falling 20 MA represents negative market action or weakness. During a strong uptrend, retracements tend to halt near the rising 20 MA. That should give you a hint there. During a strong uptrend, retracements tend to halt near the rising 20 moving average. That should tell you that the correct entry is almost always going to be at or near the rising 20 MA. When you're playing with the trend, the correct entry is almost always going to be at or near the rising 20 MA, always at or near the 20 MA. So this could be a pre-trade checklist, meaning if you're about to get into a trade, ask yourself, is the entry, am I entering at the rising 20? If you're playing long or at the declining 20, if you're playing short, if the answer is no, then you know you're about to make a mistake. Does that make sense? During strong downtrends, rallies tend to halt near the declining 20 moving average. Following penetrations of the moving average, when the stock actually starts to break the moving average, pullbacks to the now broken MA become very likely. Does that make sense? Let's take a look at some examples. MU, while the moving average is pointing up, buy every pullback to it. Don't buy it above, but just to it. Here, 3. Once it broke, right? So off the 20, nice bounces. Once it broke, look what happened, sideways, and then you keep the moving average on and you look for that halt. You look for the pattern to tighten up a little bit. And as soon as the stock starts to curl and point up, then you know it's probably ready to go. And the MU ended up going higher before obviously falling last month with the rest of the market. So we talked about the direction of the 20 MA. We talked about how it's also used in transitions, transition A and C. We talked about some basic information, some basic guidelines and information about how the moving averages need to be consistent across multiple time frames, the color, and the type of moving average that you use. Now we're going to talk about the slope of the 20 MEA. The slope or angle of the 20 MEA is indicative of the strength or weakness of the underlying stock. Okay? The slope is indicative of how strong or weak the stock is. That's common sense. 45 degree, however, is ideal because it is, when it's 45 degree, you're not burning up too much demand, right? It's sustainable. And so 45 degrees ideal, steeper would be not sustainable. It means you're starting to accelerate. Shallower than 45 degrees, it means it lacks the momentum. It's maybe sideways, but it's not really trending. So 45 degree is the picture that you want to see. How can you tell it's 45 degrees? It comes from the lower left corner of the chart to the upper right corner of the chart. Okay, that's how you know it's 45 degrees, but you got to pay attention a little bit. So this is 45 degrees, right? But take a look. It's starting to speed up, isn't it? Not only that, but this stock was up. Look at this, guys, from 150. I mean, I don't know really when it started. Um, uh, so I don't know where it came from exactly. I did take the picture this afternoon, but I had to scroll back a little bit. So look at this from 150 to now 250 nonstop. Look at the The distance to the 20 also, that's extension. We're going to talk about that next time about how to use the moving average for to measure extension overbought to oversold. So when it starts to accelerate like this, then it becomes not sustainable, right? Not sustainable. And you can actually look to play against the moving average. You can go against the trend. This is known as, this is what we call a climactic self-setup, right? Notice the drop 50 bucks, just like that in 4 or 5 days, and maybe more. Now you might say, well, you showed me all these daily charts. What's up with that? What about the intraday charts? Of course, same thing applies. Here's a 2-minute chart. Same exact thing applies. If I see a nice downtrend, I'm going to stock this. The stock short to play short right when it reaches the 20. So that's where I would look to get in a short right by the 20. So the 20 is such a great tool. It baffles me when I see educators or analysts bashing it. It means they don't know how to use it. I've made, I don't, I don't want to brag, but I've made half of the money because that I have over the years from just because of the moving average. It's such a helpful tool. I prefer that people don't use it because, I don't want everybody using it. Okay, maybe it takes away from the effectiveness. So that's the entry. What I used to do is when I was learning how to trade is enter here or enter there or enter, here, whatever. As soon as the stock broke down. Why? Because I would feel safe. I would feel like, oh, the stock just broke under the low of the day under support. So let's short it. I would short it. And then shortly after getting in, it would go back up and I'm now underwater. I would get out of it, falls again, and I would re-short right here, right under the low of the day. And shortly after getting in, it would go back up. And then at the end of the day, look at the chart and say, how in the world did I lose money pull broke under support? But let me ask you this. Does the market pay us to do what's comfortable, what's easy, what feels easy and comfortable to do? No, it doesn't. If it did, everybody would be a trader. Does that make sense? You've got to step up and short the stock when people are actually done buying it. Not when the stock is already going, you know, dropping hard. That would be a late entry. Does that make sense? So the 20 MA also helps with the entries, and we'll talk about that more later. As I said, when it starts to accelerate, that's not 45 degrees anymore. That's more like 70 degrees. Then it becomes not sustainable, and that's when you can look to fade it, to play against it, okay? To play short as when the stock goes climactic. Now, the odds of a successful trade are significantly higher when playing in the direction of the 20 MA. Odds are significantly higher for the trade when you play in the direction of the 20. But not all 20 MAs are created equal. You want your 20 MA to be going from the bottom left corner of the chart to the upper right corner of the chart. That's 45 degrees when playing long and vice versa when playing short. You want the entry, as I said, to be at or near price, not far away. You want the 20 MA you don't want the 20 MA to be crisscrossing price, to be going through price. You want it to be trending just below it or just above it and trending down if it's a short. Now, when playing long, the 200 MA, but that's a different story where I did a video on the 200 MA. This video is on the 20. When playing long, you also want the 200 to be below price, not above it, okay? That's indicative that the stock is strong across multiple time frames. that it is not just strong on the shorter time frames, on the time frame that you're looking at, but it's also strong on the larger time frames as well when the 20 and price are both above the 200 period moving average. As I said, the correct entry is almost always near the 20 MA. However, we don't enter because price is near the 20, we have to have a tradable pattern. So we look for a tradable pattern in the right location, in the right spot. And where's the right location? At or near the 20. So again, we don't enter because price is near the 20. We must have a tradable pattern there, and then we can enter. Additional use